So what I'm going to do for the next 30, 45 minutes is to introduce you in the overall assessment of the global economy. I would stick on the economy. I won't go down to the sectors or even specific branches. The simple reason for that is I am an economist, and the one thing I can do quite good, at least I guess I can do it quite nicely, is to talk about the economy and not about your sectors. If you have any questions with respect to understanding the slides, I would propose to interrupt me and ask a question. With respect to the content and further questions, I would like to ask you to ask the questions at the end of the presentation. Okay, let's start. What the economist is always doing is looking on time series. So basically he's taking the view in the back mirror. He has no idea or no better idea about how the future is looking like, but he thinks he can read some things out of the most recent developments. And the most important indicator we are looking at the very beginning is the GDP, the gross domestic product, so the sum of all goods and services produced in the economy, and there the annual change. That is shown by the bars here. On the left side you'll see the global economy, so worldwide. In the middle it's shown for the advanced economies like US, Japan, Europe, and on the far right side from your point of view, it's the emerging world, China, Brazil, and so on and so forth. The larger, the higher the bars, the better the environment is. And that tells you everything. The bars are getting smaller and smaller since 2010. They are still positive, so the global economy is still growing, but however, global growth in the last quarter, or the first quarter of 2013, was below 2%, so that's the weakest outcome since the end of the global financial market crisis. And if you look into the advanced economies in the middle, growth here was a meager 0.6% year on year. That's based mostly on the fact that the European economies are still in a very dire situation. The US economy is growing around 2 to 3%. Japan is coming back, owed to the fact that Mr. Abe has started to do the things they tried 3 or 4 times before, but anyway, they're printing more money and pumping money into the economy. It's helping, at least on the short term. However, it's not helping to compensate for the very weak situation in Europe. The interesting thing is for the advanced economies, you'll see that in the last quarter, growth was below 4% in these economies, which of course compared to the developed world is quite a nice number. However, you even see it at that bars, they used to have growth rates of around 6 or even 8% in 1 or 2 quarters. So below 4% is a very weak outcome, and basically all of the emerging economies are responsible for that. The one is China. China is not continuing to grow double-digit like we are used into it, and it will not change again. I'm pretty sure they will not come back to double-digit growth numbers, at least not on a sustainable level. They will continue to grow at 7-8%, which is quite fine with them. However, we have to adjust to that because it's something different. Another disappointing development is in India. India used to catch up with China, or at least they said they would like to do so, and they had some years with growth rates pretty close to China. There was even one year that India grew a little bit stronger than China. They have been pretty proud about that. Unfortunately, last year growth in India was only 4%. Again, 4% is not such a bad number, but if you know how low per capita income in India is, that's definitely not enough to catch up with the faster growing economies. There's one exception among the emerging countries which is still growing quite strongly, and that's the countries like Indonesia, Malaysia, Philippines, so the ASEAN states. They have been able to safeguard the very high growth rates even during the different crises we had been experienced during the last years. So that is a view back into the mirror. It gives you an understanding about the situation where we are standing right now and what is now different compared to a world, for example, in 2006, 2007, and I can tell you it's different in all regions you're active in. Even the emerging countries are not growing as strong as they did before. Well, looking ahead, you need some understanding about the attitude of the economy, of the industry. There is one indicator which is calculated right now for 70 or 80 countries on a more or less similar level. It's a sentiment indicator, a business climate indicator, and that's the so-called Purchasing Manager Index. The idea of that is to ask purchasers in the company about their understanding about most recent developments of the business. They're being asked, how was production last month compared to the month before? How was incoming orders? How was prices? how were your inventories, all these kind of things, which if you concentrate and put them together gives you an understanding about the course of the economy. This indicator is then calculated in a way that a level of 50 says the industry is probably stable or stagnating. If the index is above 50, then it's growing. If it's below 50, it's declining. And the farther away from this level of 50, the more pronounced the developments are. What you'll see is, you don't need to leave too many arguments on that. In all nations or regions we are looking at, and that are the most important you're going to track, this indicator is close to 50 or even below 50. We had some fluctuations. Those indicators were pretty weak in summer 2012. They had improved to some extent until the beginning of this year, but since then they're receding again. So if you sum up, the best you can say is we are far away from a recession. Even in the European countries, which are shown on the left side, the dark blue and the yellow line. The dark blue is European Union and the yellow line is Germany. There the index is below 50, so pointing to a declining activity in the industry, but it's not as deep in the negative territory as it was before. So what you can say is we are still falling, but not as fast or as quick as we had been falling a couple of months ago. So if you put all these together, you can say the outlook in the industry is of, at best, moderate growth. There is no upswing in sight. There is no recession, of course not, though some of the countries are still in negative. There is one exception, and that's again Japan. That's the light blue line on the left side. And again, that one is owed to Mr. Abe. If you start to pump money into an economy at the beginning, of course it is working. He has promised to conduct some structural reforms later on. So if he's going to do that, so if he's, for example, making the labor market more flexible in Japan, or is opening up the economy for international competition, then it could lead to a better outlook for the Japanese economy compared to the last 20 years. But if he's only sticking to more money printing and higher public expenditures, I'm afraid that would be a one-off, and latest in 2015, Japan would be back to the dire situation it was before. Okay, having said that the outlook is pretty, well, not very rosy, put it that way, don't put it too negative. It's not too rosy, it could be, but it could be worse. I would like to shed some light on two regions. The one is the US, simply for the fact that in the US something really had changed. Of course, they are still confronted with a too high public deficit. They do have structural deficiencies, especially in the labor market. Participation ratio in the US is still declining. Their social security system is not able to deal with the demographic change, so the aging of the society. However, a part of that, if you look on the left side, the labor market, it's improvement of employment year on year. And since quite a while, basically since 2010, end of 2010, the employment in the United States is growing by around 2%. That's the dark blue line on the left side. Even in the industry, employment numbers are rising, which is surprising for the United States, because normally in an upswing or in recovery, in economic recovery in the States, the employment in the industry shrank not too quick, but it's continued to shrink. So this time it's different. That is based on the fact, basically it has to do something with the shale gas situation, low-priced energy. If you know that, for example, natural gas costs you only 50% or 1/3 of that what you're going to pay in Germany, and if you have lower energy prices, of course, that is kickstarting or helping the industry. So the labor market in the United States is showing continuous, probably quite strong increases. So that's a positive, because if labor is rising, people have more money. Wage income still is a very important aspect to drive private consumption. The other side is showing a very early indicator for the housing market. The housing market was one of the most important aspects to understand why the financial market crisis erupted in 2008. And you'll see how steep the decline was. These indicators, housing permits, so at the beginning, if you want to start to build something, you have to ask for the permission. That is captured with the permit data, which are the light blue line. And then you have, of course, to start with your house, and that one is collected as a data in the United States as well. That's the dark blue line. So those indicators had been shrinking by 50% in 2009, and not only for 1 or 2 months, but for quite a while. However, since middle of 2011, those numbers are showing quite strong double-digit positive growth. And even if not every permission is put into a new house, at the end, if you start to build, so if you really start to dig and bring the first brick to the construction site, you have basically in mind to really finish the building. So if those numbers are going up, that tells us that the crisis in the housing sector in the United States seems to be over, and that we can expect pretty strong housing investment increases for 2013, 14, and even 15. And as that one was a very important aspect for the decline in the activity in the United States, the improvement tells us that the outlook for at least a robust growth, probably at 2%, not much higher, but anyway at 2% for the United States are quite good. So that's a positive. There are still some risks down the road, but anyway, the underlying assessment is that that is a pretty strong, but only moderate development we can expect. Well, and that brings me to the European situation. The left chart shows the unemployment rate, and it would be nice if those lines would go down. You see how high those unemployment rates are in France and Italy. That were the blue lines at the bottom. They're higher than 10% and still rising. Portugal is in the middle with some 17%, and then Spain, and I could have shown Greek as well, more than 25%, 27%. And the youth unemployment behind is even higher than 50%, and some of those countries 60%. So if people are losing their job, they don't spend money. So that's negative for private consumption. And if more than a quarter of a population don't have a job, that's even hampering a positive outlook. So how should something positive change happen if every fourth guy is out of a job? You can count, and you three have a job, you are out. The next one, the row behind, would be out of the job, and then you talk to each other. So it's a very negative sentiment effect. And you see that in the retail sales on the other side, in the same countries. Here it would be nice if those lines would go up. They don't do that. If you look at Spain and Portugal, the retail sales are at an index level of 80 compared to 2009. So if I take the number from 2009 average and say that one is equal 100, and now I would like to know how high retail sales are today, and I see it's only 80 or 82%. So at least by 20%, retail sales have been shrinking since 2009. And 2009 was already below 2008, 2007 levels. So that tells you something about the really negative economic momentum in these countries. And if you consider for Spain, for example, in Spain, the correction at the housing market, it's still not at the end. They are basically at the middle of the road. So they still have some 2, 3, or 4 years in front of them to correct for this overinvestment in retail, in housing. So it's still a very long way, apart from all the other things which probably might have happened. There's something I would like to show you, because we are normally not looking too extensively on that. We are talking about fiscal consolidation, and they're quite successful, regardless what newspapers are writing. They really have brought down the fiscal expenditures, and they have sharp improvements in the deficits in those countries. We are talking about current account, so how many goods are exported and how many goods are imported. Even there we have a lot of improvements, but we don't talk about investment activities of the companies. We just see that investment is pretty weak, not only in Germany, but especially in those countries. And normally people say, oh, because of the negative sentiment. Yes, of course, to some extent that has to do something with that. But the real issue is that the loans, corporate loans, in those economies are shrinking. Take, for example, Spain. The loans to the corporate sector have been shrinking by 9%, or almost 9% in April. That's the latest number shown here. But also in Italy, it is minus 3%. And in Germany, it is at least plus something. France, similar. So what's the reason behind? Of course, it is demand. Some of the companies still don't want to invest because they don't see the markets growing any longer. But the other argument, and that's a very important thing, is that the interest rates companies have to pay for a loan are in the crisis states are much higher than in Germany. And the reason for that is that the banking system in Europe has a lot of difficulties and problems in front of them. And even Europe-wide active banks currently do not conduct their business overall Europe as one business, but they do their business in Germany, Apart from Germany, they have some businesses in France and Italy and Spain, and there is literally no interaction any longer between them. So despite the fact that we do have the European Monetary Union, one currency, you remember there is something, the banking system is still completely differentiated, or again differentiated between Europe. And that explains these large differences in the interest rates. And as long as that is the fact, and there is no clear trend that it's going to change, the investment activity in Southern Europe will be weak. And that's something we really have to prepare for. Even if there are improvements in the employment rate, even if there are improvements in the public deficits, even if unit labor costs, I will show it a second later, are declining, so the competitiveness is improving. As long as the companies don't have access to corporate loans and to affordable corporate loans, investment will not pick up. And that's the reason, for example, why even the German government now is considering to give some subsidies for corporate loans to these countries via the KfW. Okay, however, it's not everything bad. Just to put that one on a more positive outlook. One thing I just mentioned it or crossed around it is the unit labor cost. Unit labor cost is simply a calculation of how much you have to pay in terms of salaries to produce one unit of the good. And for a global or for an economy, of course, the unit good is the GDP, and the salaries is simply the salary. You can measure that. There are some statistical errors in, but anyway, it gives you a very good understanding about the outlook or the curve of the competitiveness of an economy. And what you can see is, at the beginning in 2002, so shortly after the start of the monetary union, the Germans had been able to control their unit labor cost development quite nicely. So we had these low wage increases, we had comparable high productivity increases, so that meant that we had been able to improve our competitiveness compared to most of our competitors within the monetary union. There are the countries shown here. You see the light blue is Italy, the yellow one is Ireland, red is Portugal, this one is France, and that one is Spain. And only recently, since 2010, some of the countries had been able to reverse this trend. Most of course, because of the rising unemployment, because if you reduce your employment stronger, then you reduce your production, of course, productivity is rising, and by definition, your unit labor costs are declining. But at the end of the day, what it's counting is that those countries are regaining international competitiveness. So that's going to help them at least to stabilize the outlook for the industry. So what I'm going to say is that's not the game changer. A lot of more things have to happen in these countries to really change the outlook to make it really positive. But it's changing the outlook insofar as there are good chances that the reduction in industrial production, for example, is slowly coming to an end. So there is a chance that during 2013, the crisis states in Europe are slowly finding a bottom. Unfortunately, the outlook for a sharp rebound is not very good. But finding a bottom is the best you can hope for right now, especially after having 3 or 4 years sharply declining economic activity. On the right side, you'll see R&D expenditures, and as I'm working for Bosch, I have to come across R&D. It's not by nature I have to do so. There is a target by the OECD. It's saying that R&D expenditures should be around 3% of GDP. So a competitive economy should set aside year by year 3% of all goods and services produced for R&D, research and development. So what can we say? By the way, Germany, not shown here, it's shown, it's a gray one. It's at 2.7, 2.8, so pretty close to the target. Which is not shown is, for example, Korea, which has an R&D expenditure of 3.5, 6%. Japan is above 3%. But the important thing is that some of the states which are really confronted with an economic crisis, like Portugal, the red one, but even Spain, the very dark blue line, have started to increase R&D expenditures. And that's a little bit more than only a base effect. But or even if it's a base effect because of a shrinking GDP, you can argue as long as a company and as a state or a government is holding R&D expenditures constant in times of crisis, that's a good sign. It would be pretty easy to reduce their expenditures to go for a very short-lived gain. And apparently they didn't do so. Those numbers, unfortunately, are only going to 2010, so we don't know what had happened in 11 and 12. There still is a risk that they had gone for the short-term gains. But anyway, the underlying message of that chart is that at least at very low levels, and to be honest, the expenditures of Spain are below the expenditures of China in terms of GDP. But anyway, at that very low levels, those economies have started to understand that it's not only about consolidating fiscal expenditures and reducing unit labor costs, but there is something else, and that has to do with R&D, developing new markets, all these kind of things. It's starting slowly, and as an economist, normally tends to be a little bit naive about the future outlook. That's something I would put a little bit money on. However, it's not showing up in the next 2 or 3 years. That one will take time. If you remember, Germany started to reform its labor market in 2004, and it took at least 3 years to have the first positive results. And now we are writing 2013, and we see that it really was beneficial. So almost 10 years. And that's the horizon you have to have in mind if you consider to have a real improvement in Southern Europe. Okay, having talked, still in time. Having talked about the real economy, America quite nice, Europe facing some real deep difficulties with a slight chance of finding a bottom, and a very tiny positive indication of some improvements. I would shortly stress some developments at the financial market or capital markets, because I think it contains, despite the fact that the ECB is pumping money into the markets and to some extent really messing around with relative prices in the capital markets, it still contains some very interesting information. The one is starting here with interest rates for 10-year government bonds, which is a traditional benchmark you're looking at if you want to understand how good the quality of some government bonds are. And you remember how high these interest rate spreads in Germany or in Europe had been at the height of the financial market crisis or the European debt crisis. And here's one example, it's Italy. And you'll see since the end of 2011, and especially since mid of 2012, when Mr. Draghi announced the ECB will do whatever she can to guarantee the European Monetary Union, and believe me, it will be a lot, or it will be enough. Since that point, the interest rates of the crisis states have come down considerably. And if you see at the current level, Italy has an interest rate of around 4% for the 10-year government bond, and this level is more or less the same we had between 2009 and 2010. So it is no longer the fact that countries like Italy and Spain, it's more or less similar to Italy, not shown here, that these countries are not able to finance their public deficit any longer at the capital market. And that's different to the situation a year ago. And that's very important for the simple fact that we probably don't see an immediate risk that other European governments have to step in to support the deficit spending of southern European states. And from my point of view, you simply cannot underestimate the positive impact of these developments. As long as Italy, Spain were able to finance their public expenditures via the capital market, the immediate risk of a failure of the European Union is absent. And it seems to be pretty stable. The other interesting thing is that interest rates in the US, red, and UK, it's a dark blue here, have been bouncing back towards 2%. And an interest rate on 10-year governments above 2% can be perceived as quite normal. Or put it the other way around, everything which is below 2% seems to be not normal and not stable. And putting it the other way around, seems to indicate some underlying risks in the systems or instabilities. So the development in Germany still leaves some ground for a negative or for some pessimism, which I basically agree. But seeing these interest rates going up for these very stable states like Germany or the United States, seeing these interest rates going up is a positive sign, because it tells us that investors no longer put their money on safety, which they assume they have in investing in Germany, but they're perceiving other investments, more risky investments, as attractive again. So it's a kind of normalization. As long as the trend is continuing like that, it's not critical. Of course, there is a negative in it. Mr. Schäuble probably don't like these development, because for him it's now getting more and more expensive to finance the government debt in Germany. In the middle, there's something you probably are interested in as long as you're internationally active. It's the exchange rates. The funny thing is that despite all the crises around, the exchange rate between the dollar and the euro has not fluctuated too strongly. Of course, for the last couple of years, the corridor was between 120 and almost 150. Looks like a very wide range. But if you go back a little bit further, the fluctuation even was more pronounced. And especially for the last 6 months, the exchange rate between those currencies is only fluctuating within a very narrow band of 127 to 133, something like that. And that's really astonishing because the underlying deficiencies are so immense, you really would expect to have sharp reactions at the currency markets, especially at the currency markets where information is really priced in within seconds. Having this information only tells us, it does not tell us that everything is fine, but it only tells us that investors are still waiting how US and Euro will develop, so it's not a done deal. Even with respect to the United States, investors are not so confident that the long-term outlook is really positive. And my understanding is that one will continue for quite a while. So we can expect that the exchange rate probably is fluctuating around these 130 for the next couple of quarters in a very narrow corridor. For Japan, which is a light blue line, the Japanese yen, the situation or the story is completely different. It was extremely overvalued for quite a while against the euro and against the US dollar. And that one was really positive, thanks to printing money, that one has changed. Now we have the Japanese yen with respect to the euro and with respect to the US dollar at a level which is more or less close to the long-term average. My understanding is once you have such a strong trend, you see here, it probably will not stop after a couple of months. So there is a risk that the yen will depreciate further to, let's say, 140 or 50 compared to the euro. However, I don't see an overshooting up to 200 or something like that. But for the Japanese economy, that's good news because that really is helping their industry on the global market. And if you're purchasing in Japan, of course, you like that development as well. On the other hand, of course, from the European perspective, you should not expect support from the currencies. There is, from my understanding, at least not for 2013, there is no way that the euro is depreciating dramatically. So this support we don't see. Well, in raw material prices, if the situation is of the global economy, as I said, and will continue like that, then there is no reason why prices shall increase. And that's what you'll see. The dark blue is the oil price. So the Brent, we are back to $100 per barrel. Don't get irritated because of the scale. It's an index. We're saying 2009 equals 100. But the real price is $100, around $100, so definitely lower than it was 2 or 3 years ago. And for the industrial metals, which is a light blue, it's an index calculated by some institute in Germany, and you'll see the current price level is close to the level we saw last year, middle of last year. And that's, from my understanding, really explained by the fact that the global economy is only growing by 2%. The outlook is not for a strong upswing, but a moderate improvement. And in that environment, there is really no reason why prices should go up dramatically. So I wouldn't expect these prices to jump. Of course, they will fluctuate if you have some supply issues. For example, like we do have now it for platinum in South Africa, then of course it's showing up in the prices. But that's not a market trend, but really simply owed to the fact that there's one material which is short in supply, and of course the other way around. So basically, the markets are buying or putting their money on the fact that there is a only moderate development in the global economy. Put that one together, and that's a quite interesting chart. The dark blue line is a business climate I had shown at the very beginning for different regions. So that's a global aggregate of that. Globally, The climate is at more or less at 50. And that's what I said. It's a stable environment, no real big growth in the industry. Of course, there are service sectors which are growing, so you have moderate growth in the overall economy. But what's going on with the stock markets? That's the light blue line. And that's, of course, what you have read the recent weeks in the newspapers. So each index going for new, some of them even for all-time record. So how can you explain that? Normally you would say if a stock market is showing strong price increases, what investors are doing is they're simply putting their money on future earnings. And if the outlook is so positive for future earning of companies, then of course that has to do something with the growth outlook. So normally you would take the stock market index as a predictor of future growth. Unfortunately, and then you have to explain why is this big gap between what does the real economy think and what is the financial investor thinking. And I'm afraid the financial investor is wrong again. Well, basically he's not really wrong, because he has a problem that the central banks around the globe is pumping so much liquidity into the system that they simply don't know what to do with the money. Quite interesting conflict they do have. You won't buy government bonds. If you buy a German government bond, you got some interest of 1.50. It's not really attractive, at least for the 10 years. If you go at the short end for 2 years, you get almost nothing. There even had been some months where you had to put money on the table to get German short-term bonds. So you won't buy that one. You're going to buy raw materials? No, you didn't. You won't do that because the outlook for the economy is not really strong. You would put your money in exchange rates? Well, you really don't know what is going on there. So the safe bet, given the fact that you have to do something with your money, is a company. So you're buying companies, stock markets. So that's simply liquidity driven and not based on fundamentals. So, and that explains that anytime or every time the central banks are hinting that they are thinking to reduce the liquidity injection into the economy, these markets are tumbling. You know, the last positive news on the US economy with strong housing market, strong labor market, and stronger industrial production let the market decline. Normally you would expect, well, the outlook is bright, hey guys, let's buy stocks. No, they didn't do that. They are afraid of a change in the monetary policy. So sometimes it reminds me of on a junkie who has enough of cocaine or so, and he's only one thing fearing, that he won't get the next cocaine again. So that's the situation we do have. It's not really stable. It's something which sometimes is really bothering me. So sooner or later there is a correction underway at that market. You have to be prepared for that. And in the meantime, it doesn't mean that the outlook for the global economy is so bright. It's simply an overinvestment based on the liquidity provision by the central banks. Well, and that's now the final slide I've prepared. It's a forecast for the global economy in some of the regions. It's not done by ourselves, but from an external provider. Its source is given there, Ferry. It's a think tank in Bad Homburg. What's important? Let's stop at 2013. On the left side there, the bars showing the GDP growth of the global economy. We have calculated the global growth using 2012 GDP rates. America has a GDP rate of 20-something%, so 20% of GDP growth of US goes into the global growth. Europe has something of 18%, or Monetary Union 18%, so 18% for Europe. So ending in 2013, the story is there is no improvement. We had growth of 2.7% last year. We will have growth of 2.8% this year. The economist is really happy to tell you it's 0.1 percentage point higher. That's statistically irrelevant. You know, it's noise. It's basically more or less the same growth rate we had last year. So that's the fact. But next year everything is going to be much better. Yeah, it's a typical thing. Today is bad. Tomorrow is much better. We are happy. I don't buy the story. 2014 will not worse than 2013, there I'm pretty sure, but I doubt whether it really will be much better. It will be probably slightly better, but not really better. It wouldn't make a big difference. If you go through the regions, it's the same story. North America this year, 2.25 percentage point. Yes, it's probably, I will buy that. Next year, more than 3%, I don't see that. Europe, shrinking, it's a European Union, the EU 27, including Eastern Europe. Last year shrinking, this year more or less stagnating. Yeah, possible. Next year 1.4%. Don't bet on that. probably a little bit better than this year, but not 1.4%. If you go through that, 2.3% for Germany next year could be, but I don't think so. Many people think the German economy will show very strong growth next year, more and much better than this year. That will be happening because US growing consistently, China not double digit, but anyway growing consistently. That's especially helping the German economy with the export orientation of its industry. But whether that's sufficient to guarantee more than 2% growth, I doubt that. China, 8%, yeah, fair. India, still the point, 4% last year, and then reversing to 7%. Can happen, but I don't see it. They have to enact strongly into structural reforms. They do have general election next year. So where shall a reform take place and when? So I'm afraid India will continue to disappoint for the next couple of years. And then just as a marker, there is something else, Africa. Don't take the numbers too seriously. We don't know a lot about Africa. We know that there are a lot of countries, very promising. But apart from the fact that we don't know how strong growth will be next year, I'm pretty sure that's not really important as long as you believe that there is some development taking place, and it is taking place in these countries. So if you're looking for the next market and you're not so happy with Asia any longer, probably that one would be a destination you might have a look into it. So basically the outlook is more positive than it would have been last year, especially exactly 1 year ago, because then we talked about the termination of the European integration project. But it's not a message that from now on the future is bright. Sorry for that. But thank you for your attention.